Hello and welcome to Property Question Time. I'm Stephen Galpin and this is the programme where you can have all your property related questions answered by our team of property experts. Joining me today is property developer, investor, co-founder of Your Freedom Empire, Hayley Andrews. Welcome back, Hayley.
Thank you for having me.
Good, great to see you.
Good to be back.
And joining me for the second time now is Ben Stroud, co-founder of Grange London. That's a new estate agency specialising in new homes in the Paddington Basin area.
Stephen, thank you and good to see you again.
Okay, nice to have you here, Ben. Right, Hayley, we're going to get on with your first question, which, given your occupation, I think you're going to have fun answering this. I see so many online tutorial courses being advertised, all claiming a quick path to wealth without having to invest a lot of capital. Is the property market that easy to access with successful results, or are these business opportunities too good to be true? I'm sure some schemes are viable and realistic, but I'd love to know how to distinguish between good and bad. Oh yeah.
I always get the tough questions. No, I think first of all I'd say property and easy should never be in the same sentence. Property is a business, and like any other business, it requires hard work, dedication, time and money. Doesn't have to be yours, but you do need money to invest in property. And the more time and money that you invest in your portfolio, of course, the quicker it will grow. That being said, there are cash flow strategies that you can adopt if you do have less capital available, such as rent-to-rent, or even sourcing deal opportunities for other investors, perhaps armchair investors that don't have the time, have the capital, but not the time to source the investment opportunity. So yes, you can get into property, you don't need a lot of money available, but I would say if it sounds too good to be true, then it probably is. And while I don't like that word, there is a lot of training organisations out there that really promote a get-rich-quick scheme. And I don't think there is a get-rich-quick scheme. Well, I'm yet to find one.
They're promoting their fee structure rather than anything else, I think, in a lot of cases.
Yes, I think really what you need to be looking at, because there's so many out there, and of course the advertisements are to grab your attention. So putting an advertisement out there that says if you want to create long-term wealth, it's going to take you 5 to 10 years is not going to grab the attention. It's kind of like the fad diet mentality in today's society. We want a quick fix. So the advertisements are really out there to grab your attention. So I'd say don't focus on what they are saying. Watch what they are doing, and I think that's the most important thing. Really identify that they are investing themselves in the current marketplace and not purchased, a portfolio 20 years ago, for example. They are active, but also speak to people that they've trained in the past, go along to their free events, have a look what they are actually saying in the background. I think you need to check out the credentials of the people that are offering up these trainings.
I think you're right. A couple of things I'm going to just expand on from what you're saying. I've always thought about buy-to-let, for instance, that whilst it's good in some way, I mean, the original idea was to increase the housing stock in the rental market. That was the whole ethos between buy-to-let, for buy-to-let. But you are also taking people who have no business experience, no business acumen into their own business. And it's very easy with property to think, well, I own property, so I should make money. It's not that easy.
No, it's not.
It doesn't
easy.
work that way.
No, and that's why I said property and easy should not be in the same sentence. There's a lot of legislation. There's a lot that you need to know, and you need to obviously be aware of your responsibility. You need to be able to calculate deals. You need to be able to understand area research. You need to be able to value property yourself as well. You need to be able to have the teams around you and the knowledge and support. And it's always changing as well. So someone that purchased properties 20 years ago wouldn't be current in today's market. And I think that's, again, important, making sure that the people you're educating or getting educated through are active in the marketplace and actually doing what they're teaching. I think that's the most important part.
Well, I think also one of the things you said was you could bring in perhaps a passive partner, I think an armchair partner I think you were talking about. But I think also there it's important to make sure that all parties are bringing something to the table. So if you have a passive investor, then lovely. You're taking the part of his work, aren't you? So you've both brought something to the table.
Yes,
You don't-
someone's time versus someone's money.
Exactly. I think that's quite sensible. What do you think, Ben?
I think you've said everything I would have said. There are no quick fixes to anything in life. I think it's good old-fashioned hard work, research, surrounding yourself with good people, and you'll get there. And it's not going to happen in a year or two. It might take 5 or 10 years. But I heard a great phrase recently, which is the best time to plant a tree is 20 years ago. The second best time is today.
Exactly.
So just get on with it.
That's a great saying.
It's
I
good,
like
isn't
that.
it?
Yeah.
Get on with it, but do it with good people.
Yeah, I always say as well, just on the note on how do you actually check people out. One of my sayings is trust, but first verify. Make sure that they're good quality training organisations. There's a lot of them out there that are good. Unfortunately, they've kind of been tied up with the ones that are bad.
I've known people that say good morning to you, and before you accept it, you want to look out of the window and just make sure first.
Exactly. Yeah. It's definitely the approach that you should check.
Yes, I think the other thing, as you mentioned just then, Ben, it's very important and critical if you're just coming into the property business to build a good team around you. Good architect contact, good builder contact, good agency contact. It's very important, all these relationships, and critical to your success, really.
Absolutely, and I think that's the difference, obviously, between doing it yourself or getting educated. I'm here as an expert on the show, but the difference is mentorships and things like that collapse timeframes and give you networks, and that's the most valuable part. The education, we can find a lot of that anywhere. It's more about the teams around you, the support structure, and having someone in the industry that you can pick the phone up to and say, I've just come across a defect on the title deed. What do I do?
Yeah.
That is really the value of the network that you're buying into, and I think that's most valuable part.
Well, again, you mentioned something specific there. I think it's also quite important when you're using solicitors, for instance. If you're in London, then you do need a solicitor that's fully conversant with leasehold as opposed to freehold only, and you won't find that in the Midlands or in some of the smaller towns north of London, will you? So quite important. Okay, thank you both for that. Ben, your first question. With COVID having such a dramatic effect on the economies throughout the world, do the experts think that real estate investment in the UK will suffer as overseas governments encourage inward-only investment? I'm relating this to the thousands of properties sold each year to overseas purchasers off plan for investment, which in fairness have done a lot to support the UK's property industry.
Very valid.
Now, before you just answer that, I mean, a long time before you were born, we used to have things called exchange controls, and you weren't allowed to send money out of the country without special permission. And I think China at the moment has a system based on that theory. And I do wonder whether some of the Asia-Pacific Rim areas are going to start bringing that in, which will curtail our investment funds here, won't it? Yeah,
I think. Look, you're right. I mean, I happen to think far bigger problem than COVID is the amount of tax that's being piled on to international buyers buying in the UK. I think it remains to be seen what effect this extra 2% will have that came in April, but that's an issue for me, especially at the higher end.
If you're doing it wrong, you're getting near to 20% stamp duty, aren't you?
So I actually think that's the bigger problem. But from where I'm sitting, at the coalface as an agent, as it were, we're still seeing big demand. There's a lot of people wanting, or certainly having conversations about buying in London, but they can't get in a plane and come over. And I think when they can, a lot of people will still buy. I think it will be less than it was 2 years ago for the reasons you just gave. And we are beholden to international governments. If they decide to, India's got capital controls, China does. Without knowing the minutiae, there are ways, a lot of people already have money outside of their countries, so there are ways around it. But yes, I think it is a concern. Interestingly, I was talking to a big developer client of mine yesterday. I won't name names, but they've seen a lot of money coming from outside, domestic money coming from outside of London into London. They had 3 buyers from Cornwall last week when I thought money was going the other way. So perhaps the domestic market will offset some of that, but I think it's a very valid point.
Okay, good. Are you worried about the future of foreign investment in the country in terms of real estate?
No, I mean, from a demand point of view, we've seen no change. So I've specialised in internationals investing in UK for the last 7 years, and we still have the same number of people coming through to get educated to invest. What I have seen is a very small percentage of those people are investing in London and are now focusing more on cash flow rather than just capital.
When you say cash flow, you're talking about income
yeah.
deriving.
So they're focusing on higher yielding areas, and they're looking at holding property over a long period of time, taking the cash flow month in, month out, and getting a bit of capital growth throughout that term. And I think international investors, where it used to be the trend to just buy off plan, are actually now becoming more savvy investors and educating themselves, getting UK teams and people in place to actually implement strategies elsewhere.
Are you finding that in the Paddington area?
Yeah, I think we're seeing, it's not it was always a given that international buyers would buy new build before. So I agree with Hayley. I think now they're, you tend to find they're either, some just want London, despite the fact you can get more in Birmingham, but those ones will also now look at the secondary market as well. What can you get in a stucco fronted white block in Bayswater versus a new build in Paddington? So they're definitely, just educating themselves a lot more.
Thank you both for that. That's all we've got time for in this half of the show. Join me again after the break. Hello and welcome back to part 2 of Property Question Time. Joining me are Hayley Andrews and Ben Stroud, and I'm Stephen Galpin. Hayley, your second question. With house price rises for 2021 running at 7.5%, fueled by April's rise of 2.5% alone, do the panel think that we're heading back to the days of 10% per annum price inflation? And if so, what might be the long-term consequences of this?
So personally, I don't think that we are going to see 10% inflation on house prices year on year. I think if we look at the broader inflation, gradually rising, the Bank of England are going to be forced to raise interest rates. Also, if we look at inflation, it's currently outstripping wages as well. So affordability is going to be less. People are going to have less money in their pockets, and that will have a knock-on effect, in my opinion, in the housing market. A lot of the growth that we've seen over the last 12 to 18 months has been supported, not sole reason, but supported by government stimulus such as stamp duty holiday, etc. So as all of that's coming to an end, I do think we're going to see demand drop off. That being said, I don't think we are going to see a crash at all, but I do think it will have a knock-on effect, and I do think that we will see a price correction.
Okay. Interesting point there. You mentioned some of the incentives which are substantially aimed at the bottom end of the market for the first time buyers and that sort of thing. What it has done is seize up the top end of the market. We were talking before the show about stamp duty, and if you don't do that right as an overseas investor buying 1 or 2 properties, you can be hitting 20% before you can say whatever. Do you think that when these incentives come away, as you say, towards the end of the year, whether it will even out the market, whether there'll be a gradual increase right from bottom to top, or do you think the top will stay starved of volume?
I think we will see an even out in the marketplace across the board. There will be areas that I think will drop as well. Like I said, I think the growth that we've seen has very much been driven by the pent-up demand, first of all, everybody wanting to move house, people working from home, so rethinking their location, etc., has caused this mass movement of individuals in the marketplace. So of course that's going to even itself out. Naturally it will. While demand, I think, will stay high, I think that we will we will see either a stagnant market or a slight fall.
Yes. I suppose then we're going to get all the arguments about whether stock's available to buy, won't we? And all that. We seem to lurch from one crisis to another. What do you think, Ben?
Yeah, I think that, there's a saying that money doesn't grow on trees. It seems to have grown on trees in the last few years. If you look at what central banks around the world, all the major economies around the world are doing, is just unprecedented printing of money. I think the US printed more in June 2020. The Fed printed more dollars than in the entire history of America before that 1 month, which is pretty frightening stuff. And I think that will add fuel to the fire of inflation. And that seems to be the answer to everything, whether it's, however minor, an economic slump is, they just print more and more money. So I think there's I guess we differ a little bit on this, and I get where you're coming from, but I think there's a good chance that this wave of money we continue to see there'll be a rush to hard assets. And I think if money's cheap, if it's available, I think it will continue to see in the short to medium term
definitely
inflation, whether that's 6, 8, 10, 12% a year, I don't know.
Do you know what? I'm not always sure it's about super low interest rates or government incentives. I've always thought that if developers can be sure of selling what they build, and that means that the buying public have got the money to buy it, in other words, ease of funding, 95% mortgages, which we've referred to before, everything will be fine. It's all about availability of finance and applying that to the market. Yeah. And as I say, developers will build anything you want as long as they know they can sell it. And when you have this government criticism of developers hoarding land and not developing on it, it's simply because they know that there's either a starvation in the mortgage market, or the market overall isn't right, and they want to wait until the optimum time is there for profit. And if they don't make a profit, they're not going to survive. They're not going to be able to put in place the management structures to look after these big buildings that, it's a repercussive thing, isn't it?
Yeah.
So I think it's a very complex subject. I think that question was quite a difficult one, Hayley.
It's an opinion more than anything else, isn't it?
It is. And whoever gets their opinion to turn into fact is going to be quite wealthy, aren't they?
Well, we don't have a crystal ball, and that's the, we don't know. We can only watch previous markets, we can look at market cycles, we can look at historical events, how that has changed the marketplace, and we can make an informed decision. But really, we're guessing as anybody else is, because there's so many varying factors.
But even when interest rates went up to 15%, we pulled back from that and still sold property.
Exactly. I mean, long-term property is a good, solid asset class, and that is not going to change.
Well, I think you said the word is solid, isn't it?
Yes, solid.
You can see it, you can touch it, you can deal with it. Okay, thank you for that. Ben.
Yes.
I know this is one which you're
well
equipped to answer. Do the panel think for a young person wishing to get onto the property ladder for the first time, buying off plan is still a good idea?
For me, there's two answers to that. Buying off plan is not without risk. It can be fantastic. If you're buying in a big regeneration scheme in the first phase, right at the beginning, and you can see huge investment coming in behind you, or you're just buying at the right price, whether it's off plan or completed stock, if it's something you can see real potential in, I would say go for it. But it comes with a health warning, which is, unless that development is 3 months away from completion, you will not be able to secure mortgage finance. If you're buying something that, for example, is 2 years away from completion, you'll not be able to get a mortgage until 18 months' time. So you need to make sure you've got a big enough pot of money to protect you against any variations in LTV and any price variations, any changes in the market. Because if you don't have a good cushion put aside, you could come unstuck. So that would be my take on it.
It takes quite a clever chap to predict their circumstances in terms of income 2 or 3 years on, doesn't it? Especially at a young age when you're driving your career, you're formulating your career.
Yeah.
Quite a brave move, I think. What do you think, Hayley?
I think for a first-time buyer, it's risky. That's my own personal opinion, because it is about timing the market correctly, timing the development correctly, and then having the affordability once you need to obviously complete on the sale of that property, on the purchase of that property. And so if I was advising a first-time buyer, and I'm not, just to be clear, I would say that there's easier first-time investments for you to get into, less risky.
I think you're right, and I'll certainly give some advice, because that's why we're sitting there. And I think for young people to buy off plan, it's extremely dangerous. As I've said, it's a very clever person that can gauge their income level and therefore their ability to borrow the money 2 or 3 years in advance. I think that's a dangerous game in itself.
Yeah.
I also think in terms of price and whether there's any capital gain perspective there, it's difficult. I've always found that when a development's announced and its first launch, there might be an opportunity to have a good price while the developer is unsure of whether his pricing is right or not.
Yeah.
He's a brave developer that says no to an offer in the first half a dozen sales. Yeah. However, after that's happened, he's established his level, he knows exactly what his development's going to do. And then the only other opportunity you've got is right at the end, when the developer's got half a dozen flats left, that's all his profit tied up, and he just wants to go home and build something else.
Absolutely.
And I think they're the two sort of opportunities. But whether a first-time buyer can play that kind of gambling game, I'm really not sure, and I think if I was asked, I'd say don't do it.
Yeah, and I think you hit the nail on the head there. It is gambling, in my opinion.
Yes.
Yeah.
Yes, it really is. Okay, well, just to finish the show off, I wonder if in just sort of 30 seconds each, you'd give your view of how you think the market will go for the rest of 2021.
I think as far as it's hard to say the market for me, because there are so many nuances. I think, speaking as someone who's based and works in London, it's very much dependent on whether people start getting on planes again and when they start getting on planes, and I don't anticipate that happening before September. So if we're lucky, we'll see an uptick in the market towards the end of the year, if not, first quarter of next year. I think the outskirts and the regions will keep motoring, because they're anything below £600,000 in desirable locations will continue to be strong, in my opinion.
Hayley?
Yeah, as I said before, I think that we will see a market correction, a slight dip, or a stagnated market for a short period of time. But long term, I think we will see continuous growth, I think. And I very much invest for long term. So, yeah, overall, property is always going to remain a good
Well, they always
asset
say
class.
you should never go into property and treat it as a 5-minute business.
Exactly, because it's not. And the real wealth in property is holding that property over a long period of time.
Okay, well, there we are. Hayley Andrews, thank you very much for contributing to today's programme. Good answers, really helpful advice. Thank you.
Thank you very much.
Ben Stroud, same with you. Very good answers. I'm sure our viewers appreciate your knowledge. Thank you very much indeed for coming along.
Thank you, Stephen.
I'm Stephen Galpin. Thank you for joining us, and join me next time on Property Question Time.